Hi, this is Randy Fitting with Right Side of the Chart, and this is an early session update for Thursday, August 1st, 2024. It is 10:22 a.m. Eastern Times. I'm starting the video. We'll do a quick update on the markets. That's going to continue to be where my primary focus and my attention lies. I will update additional trade ideas as I see the opportunities present. As I say, it's always nice to be diversified, but there's also times where I overweight, trading the indexes when trading is conducive to active trading and swing trading, and right now that's what we have here. So, as I say, you got to be, nimble in a correction or in a bear market. So far, this is just a correction. Obviously, when we start losing key moving averages, and I get trend indicators that roll over on the weekly and then the monthly charts, then we'll at that point in time, whenever that comes, we'll be in a confirmed longer term bearish trend. Right now, this is just a correction. As I've said repeatedly, there's a ton of evidence, as much evidence as I've seen in years, that top is likely in, and so therefore I'll be treating it as such. One pet peeve I've always had over the years is folks that the so-called traders that say, "Oh, don't just trade the market that's in front of you, or trade what you see. Don't have any bias as well." I've learned a long time ago, if you're completely Switzerland every time, you're going to have paralysis by analysis, and you also have to, you know, um, anticipate what's going to happen going forward. In other words, in a bearish trend, if you would have, use that logic, you would have been buying every dip to what point? Where after buying all these dips, would you realize, oh, I should be shorting the rips? And so, you have to, you know, for example, you see QQQ rallying up to this resistance level here, 473.50-ish, which is the same, comparable level I gave you here on the 15-minute chart and the 60-minute charts. That's at first a minimum target. Do you want to wait to position for a breakout above that? And look, when we did slightly pop it today. All right. So if did you take that as a long? No. So, I pointed out this morning when we were in pre-market that was an objective shorting up again, or time to close the longs. And you can see they popped it just slightly, got in the gap, and so far that's failed. So as I expected, got that trade idea out to you. At the very least, a quick pullback trade this morning, and that's what you got so far. We're back to that trend line right there. I suspect my guess is we'll close red today, even though we're green now, because like I said, there'll probably be some nervous profit taking for longer term. Both flexible traders like me that bought the market recently and might still be in Apple and Amazon, but more so for those longer term investors that have seen those stocks fall quite a bit. Apple down until the recent lows, it's dropped almost 10%. And so that's gotten the attention. This is, again, I could talk about trends. Dip buyers, buy the dip, buy the dip, buy the dip, and then at some point they realize it's not working as well as it used to, and then they may want to get out. It's a 60-minute chart right there. You were also, there was a reason to buy it recently where it's support. But again, here, let me kind of summarize my thoughts here. Okay, so looking at, as I like to do going into earnings, I look at the charts and try to figure if a stock is what's going to be the next trend following earnings. Again, very important, not the initial reaction, in the after hours today or even in the pre-market tomorrow, but what's going to be the lasting trend coming out of this earnings. And, when I look at the charts, trying to be as unbiased as I can, I see a bearish rising wedge, extreme overbought conditions, negative divergences, and what appears to be just the first wave down. So even most corrective waves, if you use or corrections, if you're an Elliott waver or familiar with Elliott wave theory, you usually get at least an ABC move, and that would, let's say that would be an ABC taking you down here. I'll put a little potential target. That's certainly a target right there, support level. Just above 207. So that would be a minimum corrective wave. Now, you can't, you could certainly do that and then go up. There was a little case here where if you look at the bigger count, we had one leg down and then another leg up. But based on this, again, the both the daily chart, but more so the longer term charts, and that's what I'm going to do in this video, is just kind of loop back to the long term charts. This was the uptrend line off the April lows, clearly broken last week. A solid red candle confirming that sell signal on the weekly time frame. What would be better to see it to make a case for a deeper drop all the way down here to about the 200-ish 199 level on Apple. I want to see a bearish PPO crossover, but we get that. That's going to solidify this huge divergence that's been building, multi-year divergence, and that would most likely send us down to my longer term targets that I maintained from all the way back here when last time we peaked in 2021. This is still my target. It was back then, it was the uptrend line and or the 82 level. Well, the uptrend line is going to come in first now, and again, uptrend line I'm referring to is this one here, and that's quite a bit lower. So all right, I just wanted to kind of big picture it for you. Amazon reports tonight. So here's Amazon from a weekly time frame. Uptrend line right there, which we're headed to and we'll most likely have a reaction on. But in the near term, we had this trend line here, which was just recently broken. You had the divergence line there. So this and this line right here, your uptrend line, and this divergence line forms a big bearish rising wedge. You have a divergent high on the weekly. And remember, I always say divergences are not a sell signal. What does a sell say? They are a condition that will proceed. And when you get the sell signal, then that's your reason to get short. If you start shorting divergence or overbought conditions, you're likely to feel a lot of pain in an uptrend. So like I say, they are conditions. And then the sell signal says, okay, now that the top is most likely in. And so because of that, you had the divergence here. You had actually equaled it, equal high there, double top high. And then you can see back here, we had the trend line break right there. There was your sell signal on the weekly time frame. You back tested it, rejections, and you had the biggest bear market in many years in Amazon. So this is most likely the start of the same thing here. All I can tell you definitively, I can't make a promise to that, but I can promise you that I believe this is as I covered it recently, a solid sell signal, a long-term sell signal on a weekly chart, not just good for a 15 minute chart, active trade, 3% for. No, this is good for a double-digit drop, I believe. That's the next sell signal or objective short entry is going to come on a break below that 176.14-ish level, being that this is a weekly chart. You want to see it on a weekly basis. But what's going to happen soon, I believe, is that when this counter trend bounce that we just traded, or at least I just traded, again, I gave you scale in zone. We could go a little higher, but I'll speak to that in a minute. It's just, if you're looking long term, I think it's time to start getting back into those short positions, even though it's only been a few days on the bounce, because the upside is just not, it's only 2.5% higher. I'll get to that in 1 second. But where I'm going with this is we are most likely, once we take out the recent lows, which were my targets on NQ and QQQ, areas I expected to bounce, areas we've got to bounce, good support levels. Once those support levels go, or basically the recent lows get taken out, I think it'll be a pretty quick swoon down. So that what I'm getting at here is if you're trading on the weekly charts, kind of gets you in early. At some point you hit this, and you can see it here, where I call it the POR, point of recognition, one of the many, many terms I've made up over the years. It's my term for the kind of the psychological point where the masses realize it's a point of recognition that rut row, this isn't just a buy the dip, another correction mode. It becomes clear to the masses that the top is in and everybody's getting out at the same time. So I don't know if that's coming soon. All I can tell you is it could come very soon. Could come months down the road. Here it took a while, the topping process there. But again, this I'm viewing this as, still am, is just a counter trend rally in a bear market that started back here. And you might say, well, Randy, that's stupid because the stock's at new high. A lot of all the market leading fangs are at new highs. They're not the market. The majority of stocks are not at new highs. They're still off the 2021 and 2022 highs. And therefore, the stock market A case could be made, looking at it collectively, looking at equal weighted indexes, could be a bear market rally. And again, semantics, whether you want to call it a new bull market here and a new bear market if it comes, or you want to call it, continuation there. And you look at Amazon, really, if you step back and you look at a lot of stocks like this and in the major indexes and the equal weighted, it's basically a big double top high when you look at the bigger picture on things like that. Anywho, all right, and this is a monthly chart, so you want even higher probability that we're going a lot lower, that a bear market in Amazon's coming. Wait till you get a solid monthly close below this uptrend line. That comes off the October 2022 lows right there, early 2023s, I should say. All right, let me just cover the rest of them, so it's not a super long video. So that's it. So on the weekly chart, recent sell signals that are just fresh. On a weekly chart, you get a sell signal that's usually a trend change. It's going to last at least months, again, when you're trading off a weekly time frame. So I just wanted to reiterate, near term, a little more upside or not. Maybe Amazon wants to come and back test the trend line. Look, if it runs through there on a weekly closing basis, regains that trend line, weekly closing basis, closes above the highs, well, I'm going to tell you now, if it still has a divergent high, I'll point that out. And I'll say that maybe they just delayed the top. The technical posture won't change. When does the technical posture change for me? When you start taking out the divergences by taking out these previous highs in the indicators, and you no longer have negative divergences, okay? Until then, nothing's going to change. And again, it takes quite a while sometimes, quite often, for the weekly charts to play out for both bottoms and tops. Bottoms tend to come quicker. Remember, bear markets, stocks fall a lot faster than they rise. Corrections in bear markets are usually over. You usually wipe out years of gains in just months. And so you got to be a little more Johnny on the spot, time in the bottoms. And this was Amazon, if you go back, was one of my top picks along with Apple in the beginning, right in the beginning of 2023, long and strong, those two, and overweighting the big tech stocks. And that's when they bottomed. The rest of the market bottomed a little before that, the S&P. But big tech was lagging back then. So it's the opposite today, exact opposite. Now we had, until recently, big tech was leading, but just recently, big tech's leading on the way down, and the S&P and all those other things have been holding up. So it's almost that in reverse. And so let me just cover the rest real quick. So I already covered Apple for you. Apple, of course, below on the weekly chart, sell signals there, and those are the two reporting day Apple nails on. Microsoft, check, check, check. This is a weekly chart. There was my initial trend line right there, which we broke down, back tested for a few weeks, rejected. And then I gave you the BOD, or benefit of the doubt trend line, which was taken out clearly last week on a solid closing basis. And we're still below it. So that still takes, in the coming months, Microsoft, down to my targets. You can see them 1, 2, 3, 4. And that would be, just to get down there, if and when that's hit, let's just measure it from the highs. That's going to be a drop of about 42%, if I'm correct. And, I have additional longer term targets, but, I don't even like sharing these because I know most people think it's just crazy and insane to think Microsoft can come down to this primary bull market uptrend line. That's the bull market uptrend line off the 09 lows. And I have a high degree of confidence that line will be hit in the coming years, in the next, probably next year or two, be my guess. Again, how can that happen? It's crazy. Well, remember, stocks fall a lot faster than they rise. We saw it back here. We saw it in 2007. Microsoft wiped out in a matter of 15 months or so, 1.3 years. It took the stock back to where it was last trading in the 90s, in the mid 90s, way before the dot-com bubble. And that was the last true bear market. This one was, by all measures, a bear market, the 2021 to November of 2021 in tech, and January, the beginning of 2022 in the S&P, QQQ peak back here. But it was a bear market, but it was one also that you had, and COVID as well. COVID was what I call Ursa interruptus, bear market interrupted by the Fed, all central banks refusing to let one happen with unprecedented, never before seen stimulus. And this one here, like I said, looks like just a big tech was an outlier, an anomaly, really, compared to the rest of the stock market. And so, either way, those are my targets. And I'm kind of drifting longer term stuff, but I just wanted to kind of reiterate here, which I've been doing. We've had multiple sell signals on first, they came on the daily charts, really on the 60-minute charts. That's what got us in first. Then we got the bearish engulfings on the daily on NVIDIA, QQQ, the semiconductors, SOXX. And then you had recently this weekly solid breakdown. This is NVIDIA weekly chart. Obviously, we've been gaming down the squiggles on the 60-minute chart since the top. But that was our sell signal a few weeks ago, and it's clearly there. It's in no man's land right now. It's between the breakdown of the trend line and yet to hit my first target on the weekly, even though we've hit several targets, of course, on my 60-minute chart. This is the realm of the active trader. Covered it many, many times. So that's it. And, I could go through them all, and that's what I'm doing here, just kind of reiterating that we're coming fresh off some of the best sell signals I've seen. We've had others. We've had some pullbacks and corrections, and those all got bought up. And who knows? Maybe this one will get bought up. I'm not going to treat it any different than I would any other top. And like I said, you miss 100% of the shots never taken. And as strong as a case I could make back here that the top was in, or any of those other divergent highs and sell signals, the case is a lot stronger here. And so, what tends to happen is, and I've done this a long time, it's part of the market psychology. Bulls get emboldened, shorts get defeated and give up, and it's different this time, and we're going to go up forever, and AI is going to change the world, and these companies are going to just keep buying their stock back, blah, blah, blah. So I'll let you decide. My job is to tell you what I see, where the levels are, where things may change, and I can just tell you anytime soon nothing changes. This is, if you push back up a little bit more on alphabet, this is good resistance right here. There's also a gap right there. It may want to backfill. And this is where things start to change. And if we get up there, we'll probably punch on and, and have just keep the whole marginal new high thing going. And if so, then hopefully you made enough, on this short, and you made enough on the recent long, I'm talking on the markets or whatever you're trading, that you book profits, and you'll have stops, and it'll be a profitable trade, just like a lot of these previous short trades were. But as of now, of course, this is a possibility. For anybody to tell you that it's not, then run. Don't walk away from anyone who says the market must do this or must do that. It's just not the most probable scenario. The most probable scenario is the top is in, at least for a bigger correction. Coming down here, like I've said, to the 200-day moving averages, my deeper targets. And Meta, for example, Meta rallying after earnings today, but this is a stock that clearly looks to have peaked. Had a divergent high there, almost an equal double top, slightly higher high, which still extended the divergence, and took out this primary trend line recently. Hit support, as I covered, heading into earnings. We were on support, bounce, and it's looking at a near back test, also maybe a potential triple top high. So all I can tell you, again, charts are, subjective, if you will, kind of like those Rorschach ink blot tests, where everyone sees something different. But you cannot argue that this is not, three equal, highs or two previous highs around the same area, and we're coming up there again. So you can say what you want about where you think it's going, but you can't argue that this is not a significant resistance level nor a back test of the trend line, which it is. So again, it could push up a little higher or not. It's already broken down, and that's it. Now, if it pushes up much higher, well, it's popped those two previous highs. If it takes back the trend line, yeah, that is absolutely on face value bullish. It's bullish unless it fails. If it just makes a marginal new high and then reverses and then fails, then and the divergence is still intact, then maybe that's what we get. It's not my preferred scenario, but like I say all the time, the charts are dynamic, and so is my analysis. So every day I try to look with fresh eyes and see what's out there. Right now, today, all I can tell you is what I got out to you this morning. We're at the level that was a initial bounce target. Shorted yesterday. I went home short, as I told you. Got short again this morning, which I added to. We woke up right at that same level again. These are big levels. QQQ. Kind of recap everything. T1 was hit. Remember, T1 was all the way back here when this was on in June when I labeled it. Was either going to be the primary uptrend line or the intersecting 449.70-ish target. And as I told you, that was, we came a little above 449.79, but we hit the trend line, and we also hit the comparable support level on the NQ NASDAQ 100 futures to the button and bounced. And again, there's the bounce. So we gamed it. It's not a lot, but worth it. And make 5% sidestep. And that's what active trading to me is all about. Turn a 5% loss or give back on your profits on your shorts into a net 10% gain, if it works out right, because you game the 5% rally and then you turn around, reshort, you drop another 5, that's plus 10% onto your position from, in addition to there. Again, and of course, me, there's been more micro trades within there lately. I've been threading the needle and it's been working pretty well. So it's actually been more than a 5% net boost. That's it, guys. I don't want to beat a dead horse, say the same stuff. Like I said this morning, I put pretty good odds that they're going to, there'll be some nervous profit taking. And I'm talking about, as I said, both the longs that game this bounce recently, flexible traders like me that might have covered short and went long the Qs. To go long the Qs or NQ is to go long Apple, Amazon. It gets spread not proportionally. Proportionally would be the equal weighted index. It gets every dollar going into QQQ. Every dollar that goes into QQQ. Where's my? I used to have it listed on here somewhere. This was. I haven't updated it in a while, guys. It changes over time. You can see it. Apple used to be 12% back at the end of 2021. The end of 2023, it was 9%, and it's still really high. So in other words, every dollar going into QQQ, at least a dime is going into Apple. Another dime or so is going into Microsoft, and the rest, it starts going downhill quickly after that. Once you leave those Mag 7. The percentages are small and you get to the bottom and it's almost immeasurable. So you only have to know where the top 5 or 6 stocks are going to know where the stock market's going. Okay, and just, bigger picture stuff. Color coded that today, gave you the target range right here up to here. Not that we can't go higher. It's just, again, not speaking in probabilities, not possibilities. And this is the realm possibilities. So I was going to talk to you again. I'm going to speak to the longer term swinger trend trader that did, milk this move down, cover the lows, game the bounce, and wants to get back in. If you look at it this way, from that 473.91 minimum bounce target up to the top, it's only 2.84%. Which is still something. So there's multiple strategies. You can either all in back short there if you're willing to ride out a 2.84% drawdown, put a back test somewhat above there, ideally on a closing basis, or maybe allow for a trend line, or you can scale back in. Obviously, if you're scaling in, when you're short selling, it's being a bull or a long in reverse. When you're long, you want to buy as low price as possible, right? But when you're shorting, you want to short as high as possible. So you get better entries here. However, you can miss the turn. And based on everything that I covered, and this is where my analysis is a gazillion things in my head, and I can only convey so much at one time. But if you go back for the last few weeks, last few months, what I've talked about are unusual, very rare, extreme conditions in the market that were present with excess bullishness, evidence, including and not limited to the angry vocal bulls on the board here, but on TV, when I turn it on, I'll just listen for 5 minutes. 9 out of 10 people, they walk out there are just bullish, higher. They keep raising price targets on the video, keep telling you AI's here to stay, and these stock buybacks are just going to buoy the stock market forever, and there's going to be no recession. The business cycle's been repealed. The Fed's engineered it. We went from, was it a hard landing to a soft landing to no landing, and everybody's been in a no landing camp. Put to call ratios hitting extremes, sentiment surveys hitting extremes, QQQ record low, 52-week low short interest. All of those things couple in, and then tell me that that there are the ingredients that, and the Hindenburg crash indicator firing. Those are the indicators that tell you that it might be one of those quicker rush for the exits. than the slower roll top. Look, again, this was going back to 2021, a relatively slow roll top, right? When you look at it, we started peaking out here. Momentum was slowing, and then we went in a range for a while. We started to go down. We took out the 200s, came back up. This one has a potential to actually go down, start out with more of a bang than the last one. Again, just the potential. And when will we know? Probably soon. Amazon and Apple tonight certainly have the ability to either make or break this counter trend bounce. In other words, push us up to the next potential targets. Where to, when you look at the daily chart, that's a really good level I have here at 486.79. Big old gap right there. Major reaction high, breakout to new highs. This is where the breakout failed on a gap down. And as I often say, fewer things in trading, investing are more bearish than a failed breakout, bearish engulfing candle. So again, there was a mountain of evidence that a potential top is in, not just the top of a end of a trend, based on all that stuff. And so I'm treating it as such until then. And so, kind of going back to what I was saying, and hopefully there's some value on this, that it'd be great to either hold out and try to short all. I'll get back in short here at that max bounce target, another 2.5% higher. That would be a net 5% plus addition, right, to your versus shorting here, because you go underwater 2.5% if you are short, and then you have to get back to where you started, right, if you short here. However, I've learned this in trading, and this is why I often cover my shorts before they actually hit the support level I'm going, and why I sell my longs a little before they get to the resistance level, if that's where I think a turn is coming, because I don't want to eke out the last fraction of a percent and risk the seller stepping in early. And so, you can take the same kind of view here. So we may never get there, in other words. So, and if we don't, then you may miss out on one of the biggest drops in your lifetime, really. If you miss this whole bear market coming up, like if you missed the last one, there were a lot of folks I know. I go back, nobody wanted to short back here. Laid out targets. I laid out targets on the video that were probably heresy back then. Everything kind of changed here when NVIDIA split. Oh, I redid the target. Yeah, when it split, I had to that was my second target from back here. It was calling for 69% drop off the highs, and didn't get a lot of comments on it. And we hit it there, and then that's where we had divergences and buy signals on the market, and that ended the correction. I had deeper targets, which I still maintain. Just think it's been a bigger run up, so I've actually retasked all the targets now, and these are the current targets. I gave you these on June 26th, when I gave you the QQQ and SPY long-term targets. So that's it, kind of in a nutshell. There's where we're at. I just made the bulk of this video just supporting, or reiterating the fact we've had a lot of technical evidence, sell signals, many that I've been waiting months for. And again, better sell signals than any point in time over the last few years. More of the market-leading stocks breaking support, bearish engulfing candles, trend change indicators. We're not out of the woods yet, but if and when, once we get below the 200-day moving averages, you can see here in NVIDIA, for example, many tech stocks, the 200 days are just great. I'm on a weekly chart, so you might say, Randy, you're on a weekly. It says 40 period. Well, there's the 40 period simple moving average and exponential moving average on a weekly chart are the same as a 200-day moving average, because there's 5 days in a week. 5 times 40 equals 200. So when you look at a chart, they'll come in at the same levels. And you can see in a bear trend, you want to short rallies back to them. Once they're taken back, like they were here, you buy pullbacks to the 200. You buy pullbacks to the 200. You buy pullbacks to the 200. And you do it till it doesn't work. And then when they're clearly taken out, sometimes you chop through them a little bit. That's normal. But once they're clearly gone and clearly taken out, then you short rallies back to them. Short rallies back to them. That one you did as well. But then finally, boom, they were taken back. And then you go into bull mode. Buy pullbacks to the 200s. Buy pullbacks to the 200. They will most likely be buying, if not NVIDIA, collectively. Look at Microsoft, Amazon, Apple, all of those. And when you see the majority fall into the 200s, that's probably where the next, buying up, the next time that I'll be, reversing, covering shorts and going long for as far as swing trend accounts. So hopefully that's pretty clear. That's a pretty simple trading plan. If it doesn't play out, we go to plan B. If we start going up, we start popping through my max bounce targets, and maybe something else is going on, and I'll address that if and when that happens. As of now, that's it. I'll give you a quick update on. Now that trade's over. I told you there's a potential target, but I only listed 2, and so as yesterday I said that was my final target. Suggested take profits, which is usually, this is threading the needles. This is boom. We're in at the lows. We're out at the highs. Sidestep this give back. Crude's down. Futures are down. Pretty hefty today. But either way, you can see the nice reversal off T2. And I'll tell you what. If you did sell it and you're looking for a move back up, there's your first support right here off this level. We're right there right now. I'm just standing aside. I just hit and run, sometimes get out, wait for the next higher probability setup, but they'll probably step it up here. Remember, things are getting a little wonky again in the Middle East. Again, it's been, as you know, with, what's going on now with Iran, Israel, and taking out Hamas leader on Iranian soil, I think now, after Lebanon. So it's getting ugly over there. And that obviously can lead to higher crude prices, which, by the way, let's not forget. And I'm going to wrap the video up here. I know I'm just kind of rambling today. I don't have it queued up. If you followed me for a while, about a year ago, I created a vicious cycle. I actually called it it's a positive or negative feedback loop between 3 things: inflation, interest rates in the stock market. And I predicted this cycle, and it's been playing out to the T. You can see it, you can get in front of it, you can use the charts to trade it. So this is DJP, one of many commodity tracking ETNs. And so this drop in inflation, you got everybody cheering the Fed won the battle, inflation's low. This is general commodity prices falling, meaning inflation's going down, meaning interest rates go lower, and then stocks rally. And there's a little bit of a lag here, but you can see DJP's coming up to good support. And by most metrics, when you look at bigger picture, it's in a bull market. This was the low here. It took out all the previous highs. This has been a period of consolidation. Either way, what I've been saying, the market can't have both. So you get these bouts where all of a sudden commodity prices, inflation starts going up. The market doesn't get the memo right away. Then it starts to react. Interest rates start going up. The market throws a fit, goes down. So basically, we just had a correction in commodities. And now we're seeing crude, as you can see here, which is one of the bigger components. Crude's still very much elevated. And if we start seeing, bombs flying and, things heating up worse than they have been in the Middle East, especially in the countries where, and I'm not an expert in this, they can blow each other up in certain countries. I don't mean to sound callous, but, there's certain, the oil exporting countries, that's where if we start to see, shipping lanes get shut down in the Red Sea and Iranian oil come offline and other things like this, then and you see oil prices spike because of that, that's just not going to help Powell's case. Powell is a dove by nature. He wants a reason to cut. He ate so much crow for that stupid inflationary, transitory inflation, blah, blah, blah thing. And so there was a huge credibility loss. So it's painful for him. I can see it in his face. He's trying to pretending playing hawk for the last year or so when he's a dove by nature. They all are, Yellen before him and Bernanke before her. And my point is, he's got the all clear now. But this vicious cycle that I talk about, we've had the abatement in energy prices and housing prices and all that. And if it ticks back up, then that's not going to help the case for rate cuts. And even if it does, look, okay, let me say one more thing, and I'll do this. There were two things I want to talk about. So I watched Powell listen to his press conference yesterday. In there, and I almost busted out laughing out loud, literally by myself. He mentioned somebody asked him a question, I forget what it was, and he mentioned the yield curve, the Treasury yield curve. He said, "Yeah, it's times different. The old indicators, and he used that as an example. So the yield curve inverted, and we didn't get a recession. So these old things aren't work. Some of them don't work anymore." Okay, I and others have said this. It's never the inversion of the yield curve. I'm sorry I don't have it queued up. If you guys know what it is, Google search it. Treasury yield curve. It's never the inversion. It's always after the uninversion, when the yield curve uninverts. That's when the recession follows almost imminently. That's the timing part of it. So the yield curve inverted, and it remains inverted. And until it reverts, crosses back over, then it's not a failed signal. So the first part, it's the first shot across the bow, which tells you the uninversion is imminent. It's never inverted and stayed inverted. It can stay inverted for a period of time, a couple of years like it has. It's the uninversion, which means basically when long-term rates start going back up, and we know the Fed's going to be cutting. Even though Powell wouldn't say it, commit to it, everyone knows he will not surprise the market. The market's priced in a September cut. We're going to get a September cut, guys. I know that, even though Powell says he doesn't know it. He seems adamant, right? We're going to get that cut. So they're going to lower rates. At some point, they bring the rates down. They're going to probably have to continue with what's going to happen to the economy over the next year. There'll be more cuts. And then either long-term rates have to either just stay where they're at or tick back up. And remember, the Fed doesn't cut long-term rates. And so long-term rates are going to be determined by if our budget goes out of control, which it already is. Our GDP to debt ratio, most of you probably follow this and you know this. That's not going to get better with either candidate right now in office. Trump was a spender, despite being a Republican, was historically the party of fiscal responsibility, and God knows Kamala is going to spend whatever she can spend if it's her or whoever else we get. So bottom line is they're going to stop buying our bond. Other countries already have stopped buying our bonds. Individual U.S. investors are going to stop buying our bonds. The only way out of our mess is going to be to technically default. So if you're wondering if we go into a recession, Randy, and the Fed's cutting rates, how are long-term bonds going to go up? Well, bonds work on supply and demand. And again, the Fed does not set the 10-year bond rate. They don't set the 30. It's set by market forces. So the things that can control it are inflation, inflation expectations, or a lack of buyers. And, the foreign countries are smart, and retail investors that buy bonds, most of you, if you probably don't buy treasury bonds, but if you know how bonds work, you know that, the only way the Treasury, the federal government's going to get out of this mess is technical default. What does that mean? They're not going to stop paying interest on the bonds. They're just going to print more new bonds to issue new bonds to pay for the old ones. It's kind of like stock dilution, if you will, right? And so anyway, so that's where we could go longer term. And I know I just kind of went off on a tangent, but that's, I just had to, when he said that, I'm like, are you kidding me? You can't write off the yield curve inversion, which by the way has a perfect track record of predicting inflations. It's just, you've got to wait for the uninversion. And that hasn't happened yet, and it will happen. It's guaranteed, because we've never kept an inverted yield curve for 5-10 years. It doesn't happen indefinitely. And the other point, and I've covered this many times, and I'm sorry I don't have it queued up, but I've covered it many times in the past, and I encourage you to pull this up, go to a chart of the federal funds rate, type in Google search historic federal funds rate, get a chart, get the ones like from macro trends or whatever that'll overlay the recessions. They use a shaded gray area box to show you where all the recessions are. And invariably, as I've showed you many times, we have a rate hiking cycle like we just had. It typically plateaus. Sometimes they reverse. And only after they start cutting does then the recession come. So the mere fact that we know the next move is going to be a cut, we know it's probably going to come in September, which is now next month. History shows us, with very few, if any, exceptions, that is unlike what the market, what they try to convince you on CNBC, and what these small cap investors piling into IWM, which is a great short, by the way, right now, time to get back in. RTY, IWM. That is not a good sign. The market wants, and they've been clamoring for a rate cut, but they're asking for something that historically says, okay, the recession is now imminent and about to begin. And then earnings fall. And it's a vicious cycle. Unemployment goes up, everything else. And so for those of you that can't fathom how Apple can drop 30, 40%, 50, like I'm calling for, with these massive stock buybacks, all this cash set aside, just look at history. They were buying their stock back in 2007, 2008 when the financial crisis hit. Didn't stop it and the other big techs from going down 50% then, and it won't stop it the next time around. That I can all but guarantee you. They're just burning up. They're throwing good money at that is what they're going to be doing over the next year or so when they're buying back at lower levels. And there'll be and that's where we'll watch the technicals. We'll try to game all the bear market rallies, as many as we can. They're super profitable. I mean, there'll be days where Apple's going to be up 5-10% after dropping 20-30, and then the short covering rally comes in. So one more thing I want to show you. I mentioned the small caps, and I was listening to, yesterday when I had on CNBC to listen to the Fed announcement, and then the Powell's press conference. I heard one of the so-called pundits or some experts saying that basically it said they had no idea why the small caps rallied. They couldn't, it was a heck of a rally, and they couldn't attribute to anything. I told you what it was. It was the regional banks. It was this. I don't know how they don't know that. The regional banks are very large weighting. There's a lot of them. Almost all of them are in the Russell 2000. And I mean, all you have to do is overlay the charts if you don't believe me, and you can look at that. So this wasn't mere coincidence. So I told you recently, KRE is one of my favorite shorts, and I've held on to this one through and added to it today. I'll give you this zone right here, up from 56.50 up to 59.27. And the only thing missing before we got to the bottom of the zone, where I first started shorting it, is there were a few of the components that had not yet gotten to comparable resistance. Again, this is the KRE, the ETF that holds the regional bank sector. That's the top of my resistance zone. Nice rejection so far. And look at this. A couple things were missing back a few weeks ago. We didn't have a bearish PPO crossover. That's a big help right there. It's a pretty reliable trend change indicator. That was the last one right here. And you can see what happened the last time we had what I call a high level. This is a high level one, well above the zero line. We got that, then we got that, which is really that, and now we'll get this. So there's an actionable trade idea for you. It's the same one I'm throwing out, add to it today. And then what was missing besides the bearish PPO crossover is a lot of these banks were close to, this is the largest. I have these sorted by market cap. Truist Financial, this is the level I had on there, 45.62, has since been hit. It was back here when I first did the trade. So a lot of these were a little bit shy of comparable big resistance levels. Truist is there. PPO is about to roll over. This is one of my top picks right now, guys. Regional banks still, maintained it. This has been a short for a while. Minimum target right there. Truist is going to drop another 8% to that first target. And then down there, and it's going to take the bottom line. If you don't want to trade the regionals, it's going to take the small caps with it. All right, IWM. There's another one. Hadn't at the time when I threw it out a couple weeks ago for the first time. We were a little shy. A lot of these, boom, hit that resistance level right there. I had 174.32. This is M&T Bank. Boom, headed close to T1 already, and just one fell swoop today. So another one, HBAN, that was a level I had back here, 1507, created that on June 9th, 2021. Just hit it, rejection, divergent high, PPO crossover in the works. This is it, guys. So anyways, just wanted to point that out. So that makes it still an objective short entry or add-on for the regional banks and or the small caps, which are, it's no surprise, KRE is down big today, down 4.5%, and IWM is down almost 3% with a similar red candle, right? All right, so not rocket science, just simple, good old technical analysis. And there's also a resistance level right here. Targets, well, this is right here, 2840, 2850, the uptrend line, and then when those go, resumption of the bear market. It'll fall back into this trading range, this multi-year trading range here, and then once it falls back into that trading range, especially below that 200-ish level right there, the next stop is probably going to be the bottom. There'll be some zigs and zags along the way, so that gives us about, if you're willing to hold it, tuck it away, ride out the bumps and counter trend rallies, would be about a 27% drop. Okay, that's enough for now. Let me get the video out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.